All right, welcome back to Talk Tickers, where we slice through all the earnings call noise for you. Today, we're jumping right into West Bank, that's ticker EWBC. Now look, this has been a really anxious quarter for regional banks, right? So when their Q3 numbers hit the wire, you better believe we were paying attention. And wow, there is a lot to unpack here. So let's get right to it.
So right out of the gate, this is the number you need to see. A 12% beat on earnings per share. I mean, let that sink in. In this market where so many other regional banks are just trying to tread water and meet expectations, a beat this big, well, that's a huge signal to the market.
And you could hear the confidence from CEO Dominic Eng right at the top of the call. He didn't mince words, he called the results record-breaking. So yeah, this wasn't just about squeaking past expectations. This was a full-on statement quarter for the bank.
Okay, so let's put this surprise beat into context. We're talking about record results in what has been a really jittery sector. While a lot of their peers were stumbling, it looks like West Bank absolutely sprinted.
And this outperformance wasn't just about one thing, it was across the board. Take a look. They pulled in earnings of $2.65 per share. The street was looking for $2.35. That's a huge beat. And then you look at the top line, revenue came in at $778 million, way ahead of the $725 million folks were expecting. It was just a clean sweep.
All right, so the big question is, how did they pull this off? To really get it, we've got to pop the hood and dissect the numbers that powered this thing.
What we're seeing here is basically two engines firing on all cylinders. You've got net interest income, that's the bread and butter, the money they make on loans, coming in at a whopping $677 million. But then you've also got their fee income business kicking in another $92 million, and it's growing fast. This is exactly what you want to see, a nice, diversified way of making money.
And you know, it's not just about how much they earned, it's about the quality of those earnings. Look at these profitability metrics. An 18.5% return on tangible common equity, that's top tier, best-in-class stuff. Plus, they're growing their actual shareholder value, the tangible book value, by 5% in just one quarter. And here's the kicker, they're doing all of this while keeping their loan losses or net charge-offs super low. This is the textbook definition of smart, disciplined, profitable growth.
So what's the real engine behind all this? What's the secret sauce? Well, it really boils down to one thing, their deposit flywheel. It's basically a super-powered machine for gathering deposits.
Get this, they grew their total deposits by $1.5 billion in just one quarter. I mean, think about it. Most banks are out there fighting tooth and nail for every dollar of funding right now, and East West is just attracting it. It's the fuel that makes their whole business go. And this is what creates that powerful growth flywheel we're talking about. It's a beautiful, simple cycle. Step one, they go out and win these granular, sticky deposits from everyday people and businesses. Step two, they take that relatively cheap funding and use it to grow their loan book. And step three, that loan growth directly drives the record net interest income we were just looking at. It's simple, it's elegant, and man, is it effective.
But hey, let's not forget about that second engine, the non-interest income. Total fee income jumped 13% from last year, which is solid. But check out wealth management, up a staggering 36%. That's just explosive growth. What this tells you is they're not just taking deposits, they're building real relationships and selling more services to those same customers. That's smart business.
Okay, so the quarter was obviously stellar. But you know how it is. The market always wants to know, what's the catch? What about the risks? So let's shift gears and look at how management tackled the big concerns that everyone's worried about right now.
Yeah, what is the market worried about? This was the big question on every analyst's mind heading into the earnings call. You've got all these jitters around commercial real estate, you've got some scary headlines about other lenders, so naturally everyone's asking, where's the weak spot here?
And this really sets up the whole debate, right? On one side, you have the market's big worries. CRE weakness, the scary headlines about what are called NBFIs, and just general macro uncertainty. But on the other side, you've got management saying, hey, hold on, look at our resilient credit quality, look at our track record of low losses, look at our fortress-like capital base. It's a classic case of the market's fear versus the company's facts.
Now, I just mentioned that term NBFI, and you're probably hearing it a lot this earnings season. It stands for non-bank financial institution. So think of things like private credit funds. These are financial players that aren't regulated like traditional banks. And because there have been some high-profile blowups elsewhere, analysts are putting every bank's exposure to these guys under a microscope.
And on the call, management's rebuttal on this was really direct and really forceful. They laid it out point by point.
First, they have zero direct exposure to any of the troubled names you've seen in the news. Second, their NBFI book is only about 13% of their total loans. Third, these are long-standing clients they know well. Fourth, the loans are backed by independently validated collateral. And maybe most importantly, this portfolio has practically zero history of losses. They really did a great job of shutting down those concerns and de-risking the story for investors.
But it wasn't just about playing defense and managing risk. Management also pointed to a massive opportunity on the horizon, and the number is $18 billion. That is a huge number. That's the value of their time deposits, CDs, that are all coming up for renewal in just the next 6 months.
So why is that such a big deal? Well, think about it. As the Fed continues to cut interest rates, East West Bank gets to take that entire $18 billion block of funding and reprice it at a much, much lower cost. This is like a powerful built-in tailwind that's going to help boost their profits, their net interest margin, as we head into next year.
Okay, so let's put it all together. What's our take on the next call? We're going to break it all down into our forward outlook and our official rating.
So here's what you should be watching going forward. First, for the rest of this year, it's all about deposit growth and how that net interest income holds up as the Fed starts cutting rates. Then, around the middle of next year, keep an eye out for the launch of their new FX platform. That could be a nice little kicker for fee income. And then for the full year 2026, the story will be all about capital deployment. How much are they going to return to shareholders through buybacks and dividends?
And all of that brings us to the Talk Ticker's verdict. For the next quarter, we're looking for resilient NII and continued strong deposit growth. In terms of price action, we think this stock has clear potential to outperform the broader regional banking index, the KRE. So when you add it all up, the record results, the really buttoned-up risk management, and that clear path of catalysts ahead, our official Talk Ticker's rating on East West Bank is outperform.
And as always, please remember this is for informational purposes only and is not financial advice.